Last week, I received a call from a panicked prospect, and he said, I just realized that I failed to take my RMDs over the past 2 years. What should I do? Now, to most of you watching this video, it is no surprise that one of the biggest challenges you'll face in retirement is both managing and planning for required minimum distribution. After years of saving money in your 401k and your tax-deferred accounts, eventually the IRS is going to want their cut. And if you don't understand how required minimum distributions work, you could get caught paying way more in taxes than you need to. So in this video, we'll cover everything you need to know about RMDs, including what they are, when they start, how they're calculated, and how inherited IRAs differ. We'll also include some recent updates which have caused a lot of confusion. And of course, I'll share smart strategies for navigating around RMDs and reducing your tax burden. But first, my name's Kevin Lum. I'm a certified financial planner, and this channel is dedicated to helping 1 million people retire without worry. Now, at some point, as you know, the IRS will start forcing you to take money out of your tax-deferred retirement accounts through required minimum distributions. So first, what is a required minimum distribution? An RMD is a mandatory distribution that you must take from your tax-deferred retirement accounts. The most standard accounts are 401ks and traditional IRAs. But honestly, it might just be easier to tell you what qualified retirement accounts you're not required to take a required minimum distribution from. The main accounts that don't require an RMD are an HSA, a Roth IRA, and as of 2024, a Roth 401k. That's a big change that's caused a lot of confusion. So then the next question is when do RMDs start? For most people watching this video, your RMDs will begin at age 73. The Secure Act raised the age for RMDs to 73 for people who turned 72 in 2023. Beginning in 2033, the age will jump to 75. But as of now, most people watching this, if you haven't already started your RMDs, you will be required to take them beginning at age 73. Now, your first RMD must be taken by April 1st of the year after you turn 73. After that, the RMD must be taken by December 31st of each year. Now, what happens if you don't take your RMD? If you fail to take your RMD, you could be subject to a 25% penalty on the amount you should have withdrawn but didn't. Although this penalty can be reduced to 10% if you take the distribution within the correction window. Now, these fees have recently come down significantly. They used to be 50% of the missed amount. So just quickly to show you how that works, if you are supposed to take an RMD in 2024 or 2023, let's say, for $10,000, you missed taking that distribution, then historically you would have owed a $5,000 penalty on that missed distribution. Now it's $2,500, and if you do it in time within the correction window, it will only be 10%, which would be $1,000. Now the next question that confuses a lot of people is how are RMDs calculated? Now I wouldn't stress too much about this because most custodians can help you do that, and there's a number of calculators online that will help you figure this out. Problem is a lot of information about RMDs and IRAs in general are really outdated, including some information on the IRS website. And so you want to make sure you have an up-to-date and trusted source you're using to help you make these calculations. But the calculation basically works like this. So it's based upon the ending account balance of the prior year. So the account balance of whatever account you're taking an RMD on December 31st. Then you take that number and then you're going to divide it by the number from the uniform lifetime table. Now, if your spouse is more than 11 years younger and is the sole beneficiary of your tax-deferred account, then you will use Table 2. But for most of you, you're just going to use Table 1. So basically, this is a number based upon your life expectancy, and you're going to take that $100,000 ending account balance, and you're going to divide it by this number. As your age increases, the percentage which you need to withdraw from your account is also going to increase as well. So let me give you an example. If you have $500,000 in your IRA on December 31st and you're age 73, you'll need to take $500,000 and divide it by 26.5. So that's what for age 73, that's the number you'll need to use. So your RMD is going to be $18,867 or around 3.77% of the account value. Now let's look at the next year. So we'll assume that your account grew by 8%. It was a good year for the 60/40 portfolio. So now after withdrawing the money, you have $481,000 left in your account. But if that $481,000 grew by 8% because the 60/40 did well, now you have $519,000, almost $520,000 in your account. But now you're a year older, your life expectancy is less, and so you're going to divide 520,000 by 25.5, which means your RMD amount will be even more. It's quite often the case that RMDs will continue to increase and cause a larger and larger tax burden, pushing you into a higher tax bracket and possibly even causing increased Medicare. This is why it's so important to have a strategy for how you manage your RMDs. So another question that people often ask is, how are RMDs taxed? RMDs are taxed as ordinary income by the federal government. State rules are going to vary. And so often these distributions push you into a higher tax bracket because it just shows as additional income. Now, the only caveat is inherited Roth IRAs. They require an RMD, but there is no tax on those distributions. This increasing ordinary income can be a significant burden, especially for higher earners and people who saved really well during their pre-retirement years. Now, before I talk about how we can reduce our tax burden and manage around RMDs, let's talk for a minute about inherited IRAs, because a significant number of people will have an inherited IRA, either from a spouse or a family member. Now, when talking about inherited IRAs, the first question is always, who did you inherit the account from? If you inherited the IRA from your spouse, for most people, the option is going to be pretty straightforward. You can simply roll it over into your own IRA and treat it like your own, and the same rules that apply to your IRA will apply to your spouse's IRA once you roll that over. You can keep it as an inherited IRA and follow a different set of rules. Now, most people will want to roll it over into their own IRA and just kind of simplify everything and allow one set of rules. If you're under the age of 59 and a half and you want to take immediate distributions without penalty, then you have a choice to keep it as an inherited IRA and basically stretch it out over your life on your own life expectancy table, but you will have to take an RMD every year, or you can follow the 10-year rule. Now, what about non-spousal distributions? If you received an IRA from someone who passed after December 1st, 2019, there's a whole different set of rules rather than if you received it from someone who passed before December 21st, 2019, just to make it slightly more confusing. But I'm going to focus primarily on the rules applying to people who inherited an IRA from someone who passed after December 31st, 2019. Generally, the designated beneficiary, that might be you, is required to liquidate the account within 10 years following the death of the account owner. This is often known as the 10-year rule. But if the decedent had already started taking an RMD or was supposed to take an RMD may be required in years 1 to 9. You still will have to liquidate it within 10 years, but you're going to have to start taking RMDs sooner rather than later. So you don't have the luxury of the 10-year rule. As one person I read said, when you turn on the spigot, the IRS does not like to turn it off. If RMDs had not yet begun, then you can just wait till the end of the 10th year, never take a penny out of the account, and then take one large distribution. Now, for tax reasons, that's probably a bad idea, but you could. Now, some of you who've really paid attention to this over the years might be saying, yeah, but what about the stretch rule that I used to read about? A stretch rule is basically where a younger recipient could extend the time they had to take the RMDs out of the account based on their life expectancy. So, if the recipient was 30 years old, they could have an incredibly long time to kind of take that money out of that account. That loophole has now been closed for most people. However, there are exceptions. The exceptions are the spouse, minor children, disabled family members, which is a fairly strict definition, someone who is chronically ill, which is also a fairly strict definition, and persons who are less than 10 years younger than the decedent. So maybe you inherited your sister's IRA. There's not a large age difference. You might be able to use your age to calculate the withdrawal. These individuals, sometimes referred to as eligible designated beneficiaries, may be able to withdraw or to stretch out the funds on the basis of their life expectancy, allowing them to defer the distributions from the inherited accounts for a much longer period of time. Now, one note, once a minor reaches the age of majority, so if they inherited as a minor, once they reach the age of majority, they're going to need to distribute the entire account within 10 years. Now, if you need things to be slightly more complicated, that loophole for the stretch withdrawal over decades is still in place if the person who owned the account died before January 1st, 2020. Clear as mud? Okay. One final note, if there are multiple beneficiaries on the inherited IRA, the IRA can be split into separate accounts for each recipient, which is a smart choice for most people. If you want to split the IRA, you must do so by December 31st of the year following the original owner's death. And any non-individual beneficiary, which is going to be a rare case, but they must use, unless it's a qualified trust, they must use the 5-year rule if the owner died before beginning to take RMDs. Now, of course, money you withdraw from a tax-deferred retirement account is generally going to be taxable. And so this could create a problematic tax situation because you're going to be forced to take out extra income, and it's going to make it really hard to control your income. And a lot of people are trying to control their income, trying to manage to stay within a certain tax bracket, trying to keep from having the phantom tax of Social Security being taxed or having an additional Medicare premium. So the question becomes, how do you reduce the impact caused by RMDs? There are a few options. The first option is just taking qualified distributions before you're required to take RMDs. Now, in some cases, it might make sense to wait as long as possible to allow the money to continue to grow tax deferred, but often, it might make more sense if you have a large amount of tax-deferred savings to start withdrawing the money as soon as possible so you can better manage the tax brackets by lowering your balances before you reach your RMD age. So even if you have an inherited IRA, you might want to take out, even if you can wait 10 years, you might want to take out a little bit each year so you don't have one lump sum hitting in one tax year, pushing you up into a higher tax bracket. Because you might be able to withdraw, say, $10,000 a year if you inherited $100,000 and be able to stay in a lower tax bracket. But if you make $100,000 a year and then you get a $100,000 distribution, it may push you up into a higher tax bracket, causing more of the money from that qualified account to be taxed. Whereas if you took a little bit out each year, you could stay under a certain tax bracket, and then you can also just reinvest that money once you withdraw it into a taxable account. So you can still have market exposure without having one giant lump sum that you have to take. So the first thing you can do is just begin taking distributions before you're required to. The second thing you can do, and this does not count for inherited IRAs, so underline that somewhere if you're taking notes, but as you can begin to do Roth conversions. Now, I'm not going to go deep into Roth conversions because I just did an entire video on Roth conversions that I will link to at the end of this video. But Roth conversions for many people can be one of the smartest decisions you will make. It could save you a fortune in taxes, both in your lifetime, but it could also save your heirs a large sum of money. But once again, this only works on your own IRA. If it is a spousal inherited IRA, you can roll that into your own IRA and then do Roth conversions. But as long as it's still an inherited IRA, you cannot do a Roth conversion. The third thing you can do is a qualified charitable distribution. If you're 70 and a half, you can take a qualified charitable distribution, which allows you to make a tax-free donation of up to $100,000 a year directly from an IRA to a qualified charity, which will satisfy part or maybe all of your RMD requirements for that year. After 2023, this amount is going to be indexed to inflation. And so if inflation goes up, the amount, that $100,000 will also go up just a little bit as well. So this is a great strategy for both doing good in the world, but also reducing your RMDs. And you can do a QCD on an inherited IRA, assuming that you are 70 and a half. So that's kind of the threshold. As long as you're 70 and a half, you can go ahead and do a QCD, whether it's your own IRA or whether it's an inherited IRA. The other option is invest in a qualified longevity annuity contract. And this is fairly new. The laws just changed around this, and it's kind of controversial. Advisors disagree on it. I think for the right person, it could be a good strategy. But QLACs, which is what they're often shortened to, are deferred income annuities that are guaranteed sources of income when you reach a certain age. And because not everyone who buys this deferred annuity will live long enough to reap the benefits, they offer a much higher payout than other annuity products or other guaranteed income products. And you can transfer up to $200,000 of, let's say, your IRA to a QLAC with no tax consequences when you make the transfer, provided you are between the ages of 73 and 85. This is not possible on a Roth IRA or on an inherited account, but you can take up to $200,000. You can buy one of these qualified longevity annuity contracts, which have a higher payout. And the benefit of it is it both reduces the amount out of that qualified account, so you have less to take out in RMDs. And then it also provides you guaranteed income later in life. One of the concerns that a lot of people have is that at some point they're going to run out of money. And so the benefit of the QLEC is that you have a guaranteed pool of money later in life. You may never end up using it, which is kind of the bet that the insurers are making. But if you're one of the people who beat the averages, and there are a lot of people who beat the averages, then it could be a really good deal because you could have it set at age 85 to kick in income, and you could have a high level of guaranteed income without having to pull from your retirement accounts for the rest of your retirement. Now, that money is going to get taxed when it comes out, just as ordinary income, just like your annuity would be. So you're not going to avoid the tax completely, but you are able to delay the tax. But like I said, I have another whole video where I go in a bit deeper into that. So that is a very brief overview. Some of you who have been sitting watching this are thinking that wasn't very brief, but it's fairly brief. I tried to just hit the key points, but the key is to have an intelligent plan to minimize your RMD taxes based on your unique situation to avoid getting caught off guard by RMDs like that person who called me just a couple days ago. So make sure you know the rules so you can optimize your RMDs. And I'd be interested to know what questions you have about managing your required minimum distributions. Let me know in the comments. Then I have a playlist here that's going to link to a few of our videos on retirement and taxes because I think they all kind of go together, talking about withdrawal strategy, talking about Roth conversions, and then also talking about required minimum distributions.